If you want to understand how wealth is actually built, you have to look closely at the one thing that terrifies most ordinary people, yet is used constantly by the rich. That thing is debt. Many people think all debt is the exact same, but that is like saying a butter knife and a chainsaw are the exact same thing because they both happen to cut things. If you try to use a chainsaw to slice your morning toast, or if you use it without knowing exactly what you are doing, you are going to face an absolute disaster. But if you use it carefully, with deep respect for its power, and for a very specific job, it is an incredibly efficient tool. Most people spend their entire lives oscillating between two extremes when it comes to borrowing money. On one hand, you have folks who are entirely terrified of debt, who believe that borrowing a single dollar is a moral failing. On the other hand, you have folks who are completely overwhelmed by it, using credit to finance a lifestyle that their income simply cannot support. Neither of these extremes will help you build a secure, lasting financial foundation. Think about the messages you receive every single day. If you walk into a bank or log on to a financial app right now, they will happily, almost aggressively, lend you money to buy a depreciating car, a vacation you cannot actually afford, or a television that will be technologically obsolete and financially worthless in 5 years. They make it incredibly easy to borrow money for the absolute worst financial decisions you can make. At the same time, traditional financial advice often swings to the opposite extreme, yelling at you that every single form of debt is a terrible, evil thing that must be avoided at all costs. This leaves the ordinary, hardworking person deeply confused. You are told to fear debt, but you are constantly handed a credit card. In my lifetime, and in spending decades watching exactly how capital works and how human beings behave with money, I have seen the true nature of leverage. I've seen debt help sensible, patient people build extraordinary security for their families, and I have seen it completely wipe out very smart, highly educated people who simply got greedy or impatient. The tool itself is entirely neutral. The chainsaw does not care who is holding it. The difference between the person who builds wealth and the person who ends up bankrupt lies entirely in how the tool is applied and the rules they refuse to break. To understand this, we have to start separating the concept of borrowing into two entirely different categories: destructive debt and productive debt. Destructive debt is the kind that the modern consumer economy pushes on you every single day. It is borrowing money to consume. It is taking on a high-interest loan to buy something that actively goes down in value the moment you take it home. When you use debt this way, you are literally selling your future time and labor to a bank just to have something shiny today. You are chaining yourself to your desk. Productive debt, on the other hand, is what we call leverage. It is used exclusively to acquire an asset that generates cash flow or securely holds long-term value. When you use leverage correctly, you are not buying a depreciating toy. You are buying a machine that works for you. But even then, the rules of gravity still apply. Leverage magnifies your gains, but it multiplies your losses in the exact same mathematical way. That is why the wealthy, the ones who stay wealthy, do not use debt recklessly. They use it with an obsession for safety. They demand a margin of error so wide that no single economic storm can wash them away. Now, you might be thinking that this only applies to billionaires or massive corporations or Wall Street bankers. That is a dangerous misconception. The principles of productive debt apply just as much to the ordinary worker trying to figure out how to buy a modest home, how to manage their credit cards, and how to eventually retire with dignity. You do not need to use complex corporate leverage to build a wonderful, secure life for your family. You simply need to respect the tool. You need to know when to leave the chainsaw in the shed and when it is safe to turn it on. Today, we are going to walk through the stark mathematical difference between the debt that keeps you permanently broke and the productive leverage that can help an ordinary family build a sturdy financial foundation. We are going to look closely at the illusion of the affordable monthly payment and why high interest is a tax on the impatient. We will explore the absolute necessity of a margin of safety so that you are never forced to sell your assets in a panic. We will also discuss the invisible tailwind of fixed-rate borrowing in a world where inflation constantly eats away at the value of paper money. Most importantly, we will connect the cold, hard math of borrowing to the psychological weight it places on your shoulders. Because true wealth is not about maximizing every last penny of potential profit through dangerous amounts of leverage. True wealth is the quiet, unshakable security of knowing that time is working for you, not against you. It is the ability to sleep soundly at night. If you can learn to distinguish between the debt that destroys and the debt that builds, you can stop working to pay interest to someone else and start using safe, structured strategy to buy back your own future. Let us begin by looking at the trap that catches almost everyone, the math of destructive debt. If we are going to understand how to build lasting wealth, we first have to understand exactly how wealth is systematically destroyed. When most people think about financial ruin, they picture a massive, dramatic event. They imagine a stock market crashing by 50% in a single week, or a risky business venture going entirely bankrupt, or a sudden catastrophic loss of a job. But for the vast majority of ordinary, hardworking people, financial destruction does not happen overnight in a dramatic flash. It happens slowly, quietly, and entirely by design through the simple mathematics of destructive debt. Before we can talk about how successful individuals use leverage to get ahead, we have to look the monster of consumer debt straight in the eye. We have to deeply understand why borrowing money to fund your daily lifestyle is the absolute fastest, most mathematically certain way to guarantee that you will spend the rest of your life working for someone else. The most dangerous trap in the modern consumer economy is what I call the illusion of the monthly payment. 50 years ago, if you wanted to buy a refrigerator, a reliable car, or a television set, you walked into a store and asked one simple logical question: how much does this cost? You looked at the total price, you looked at the balance in your bank account, and you made a rational decision based on the actual value of the item. You either had the money or you did not. Today, the entire retail and banking system has been completely re-engineered to hide the total cost of ownership from you. When you walk into a car dealership or a high-end furniture store, the salesperson rarely wants to discuss the final out-the-door price of the item. Instead, they immediately ask you a highly engineered psychological question: how much can you afford to pay per month? This sounds helpful. It sounds like they are trying to fit this purchase into your budget, but the moment you agree to negotiate based on a monthly payment, you have already lost the financial game. The lender will simply stretch the term of the loan out to 5 years, 6 years, or even 84 months just to make that monthly payment artificially shrink to fit your immediate budget. They make the math look incredibly easy to swallow today while quietly chaining you to years and years of compounding interest. You are no longer just buying a product, you are buying the illusion of affordability. You are paying a massive premium for the privilege of having the item right now instead of waiting until you have actually earned the money to pay for it. Let us look closely at the most common wealth-destroying example of this phenomenon: the modern automobile loan. For an ordinary worker, having reliable transportation is an absolute necessity. You need a car to get to work, to take your kids to school, and to manage your life. But the way we finance that transportation is a mathematical tragedy. When you walk onto a dealership lot and finance a brand new $35,000 vehicle, you are immediately hit with a devastating double whammy. The moment you sign the paperwork and drive that shiny new car off the lot, it mathematically loses about 20% of its value. It is instantly transformed into a $28,000 asset. However, because you financed the purchase over 6 or 7 years, the bank does not care what the car is worth today. You are paying interest on the original $35,000. By the time that long-term loan is finally paid off, that car might have cost you $42,000 or $45,000 in total capital out of your pocket. So you have paid $45,000 for an asset that is now, after 7 years of driving, perhaps worth $8,000 or $10,000. For the entire duration of that loan, you are completely underwater, owing the bank far more than the underlying asset was actually worth. This is the exact definition of destructive debt. You are using borrowed capital and paying interest to purchase a heavily depreciating asset. It is the financial equivalent of trying to fill a bathtub with the drain wide open. But as terrible as a long-term car loan is, it pales in comparison to the most mathematically devastating financial product ever created for the ordinary consumer: the high-interest credit card. Millions of good, honest, hardworking people carry balances on their credit cards month after month. They tell themselves that it is just a temporary situation and that they will eventually catch up when they get their next raise or their next tax refund. But the math of credit cards is incredibly unforgiving, and it is designed to keep you trapped. When you carry a credit card balance at 18, 20, or 24% interest, you are effectively putting a massive invisible anchor around your own neck. I have spent my entire adult life allocating capital, studying businesses, and looking for ways to safely compound money. And I can tell you this with absolute unshakable certainty: I do not know of any legal, reliable way to guarantee a 20% return on investment year after year. The greatest professional investors in the history of the world cannot consistently outperform a 20% hurdle rate. So, if the most sophisticated financial minds on Wall Street cannot generate a guaranteed 20% return, you absolutely cannot outinvest a 20% credit card bill. It is mathematically impossible. When you borrow at those rates, you are guaranteeing a massive negative return on your own life. You are aggressively betting against your own future. You are digging a hole with a bulldozer. and trying to fill it back in with a teaspoon. The profound tragedy of the credit card is that it allows you to finance your daily lifestyle. It allows you to buy designer clothes, expensive dinners, and premium vacations that your current income does not actually support. This is what I call the ultimate tax on impatience. High-interest consumer debt is simply a financial penalty you pay for refusing to wait. When you take your family on a $5,000 vacation and put it on a high-interest credit card that you cannot pay off at the end of the month, you are not just borrowing money from a bank, you are mortgaging your future time. You are making a binding mathematical agreement that your future self will have to wake up early on a cold Monday morning, drive through traffic to a job you might not even like, and work for several hours just to pay off the interest on a steak dinner you ate 2 years ago. Your future labor has already been sold. You have voluntarily handed over your personal autonomy to a financial institution. This is exactly why people who are drowning in consumer debt feel so incredibly exhausted and anxious all the time. They are running on a treadmill that is constantly speeding up because compounding interest works 24 hours a day, 7 days a week, and it never ever takes a vacation. It is very easy to fall into this trap. We are all human. We all want comfort, convenience, and nice things for our families. The people who get caught in destructive debt are not foolish. They are simply fighting against a highly optimized multi-billion-dollar system designed to make borrowing feel completely painless in the short term. But if you want to build actual wealth, you must look at this math, see it for what it truly is, and firmly refuse to play the game. You must radically reject the idea of borrowing money to buy things that immediately go down in value. But this raises a very important, inevitable question. If debt is mathematically this dangerous, if it is this destructive to your future freedom and your peace of mind, why do we constantly see the wealthiest individuals and the most successful corporations in the world carrying massive amounts of debt on their balance sheets? Why do the rich borrow money if borrowing money is a trap? The answer lies in the completely different way they apply the tool. They do not borrow to consume. They borrow to acquire. And that introduces us to the other face of the exact same coin, the concept of productive leverage. If consumer debt is as mathematically dangerous and emotionally draining as we have just established, a very logical question naturally arises. Why do the most successful investors, the wealthiest individuals, and the largest corporations in the world use borrowed money at all? If debt is a trap, why are the rich constantly borrowing? The answer is that they are not using debt to consume. They are not borrowing to buy televisions, luxury vacations, or depreciating automobiles. They are using debt to acquire productive assets, and they are utilizing a financial concept known as leverage. To understand leverage, you first have to think about basic physics. If you have a massive, heavy boulder sitting in your yard, you cannot lift it with your bare hands. Your physical strength is limited. But if you take a long, sturdy metal bar, wedge it underneath that boulder, and push down on the other end, you can move a weight that is 10 times heavier than you are. The metal bar is a lever. It multiplies your physical force. In the financial world, leverage does the exact same thing, but instead of multiplying your physical force, it multiplies your purchasing power. It allows you to use a small amount of your own money combined with other people's money to control a much larger income-producing asset. Let us look at a very plain, ordinary example with simple math so you can see exactly how this mechanism works. Imagine you want to buy a small piece of real estate, perhaps a modest rental property or a small commercial building. The total price of this property is $100,000. You have two choices for how you can buy it. Your first choice is to simply pay $100,000 in cash. You hand over the money and you own the property outright, free and clear. Let us assume you hold the property for a year. The market goes up and the value of that building increases to $110,000. You made a $10,000 profit. Because you invested $100,000 of your own cash, your return on investment is exactly 10%. That is a solid, respectable, and very safe financial outcome. But now let us look at your second choice, using financial leverage. Instead of paying cash, you decide to put down only $10,000 of your own money, and you go to a bank to borrow the remaining $90,000. You still buy the exact same property, you still control the exact same asset, and let us assume the exact same market conditions occur. The property goes up in value to $110,000. You still made that exact same $10,000 profit. But here is the critical difference. Because you only used $10,000 of your own actual cash to get into the deal, that $10,000 profit represents a 100% return on your money. You just doubled your money in a single year simply by using the bank's capital to do the heavy lifting. This is the intoxicating, almost magical math of leverage. When times are good and asset prices are rising, Leverage accelerates wealth building in a way that pure savings simply cannot match. It makes people feel like financial geniuses. It is the reason you see real estate developers, private equity firms, and aggressive investors utilizing borrowed money. When the wind is at your back, leverage makes you fly. But here is where the story gets incredibly dangerous, and this is the part that ordinary people, and frankly many highly educated Wall Street professionals, conveniently forget when the economy is booming. Leverage has two faces. It is completely indifferent to your hopes, your dreams, and your hard work. It magnifies your gains beautifully, yes, but it multiplies your losses in the exact same ruthless mathematical way. It is a perfect mirror. And if you do not understand the dark side of that mirror, it will eventually destroy you. Let us run that exact same mathematical example in the opposite direction. What happens if the economy stumbles? What happens if interest rates rise, a major local employer shuts down, and the real estate market drops? Let us say the value of that property drops by just 10%. It goes from $100,000 down to $90,000. If you were the buyer who paid $100,000 in pure cash, you just lost $10,000 on paper, a 10% loss. It hurts. It is a bad year, and you might be frustrated. But you still own the building. You are not ruined. You can simply hold on to the property, collect the rent, and patiently wait 5 or 10 years for the market to recover. You sleep perfectly fine at night because you have holding power. You survived the storm. Now, look at the buyer who used leverage. You put down $10,000 of your own money and borrowed $90,000 from the bank. The property drops by 10%, bringing its value down to $90,000. Your entire $10,000 down payment is instantly erased. A mere 10% drop in the overall market just wiped out 100% of your personal equity. You are completely wiped out. If the bank suddenly demands additional collateral, or if you lose your job and cannot make the monthly mortgage payments, you are forced to sell the property at the worst possible time. You walk away with absolutely nothing. In fact, if the property drops by 20%, you now owe the bank $10,000 more than the building is even worth. You are financially trapped. This is the harsh, terrifying reality of the risk of ruin. When you use leverage, you are fundamentally trading away a piece of your control. When you own an asset outright with no debt, you dictate the timeline. You can hold through recessions, panics, and economic downturns. But when you are heavily leveraged, the lender controls your timeline. If the market panics or if your personal income temporarily dries up, the bank does not care about your long-term optimism. They will force you to liquidate at the absolute bottom of the market. I have seen brilliantly smart people with high IQs, excellent education, and great business ideas completely destroyed. They were not destroyed because they were wrong about the long-term value of the asset. They were destroyed because they used too much debt and could not survive a temporary short-term drop in the market. This brings me to a philosophy that has governed my entire life, and it is a rule I urge you to adopt immediately, no matter how much money you currently have. I have always operated by one strict rule. I never risk what I have and need for what I do not have and do not need. Think about the profound truth hidden in that sentence. If you have a stable life, a roof over your head, and enough income to take care of your family, you already possess what you fundamentally need. Why on earth would you borrow heavily, risking your absolute baseline security, just to get a slightly bigger house, a fancier car, or a chance at getting rich a few years faster? It is pure madness to risk your peace of mind for something you do not actually need. Greed blinds people to the downside. They look at the math of leverage and they only calculate the sunny days. They assume their job is perfectly secure, their health will never fail, and the economy will only ever go up. But financial history tells us that economic storms are guaranteed. Recessions, market crashes, and personal emergencies are a normal, unavoidable part of the financial weather system. If you are leveraged to the absolute edge of your capabilities, you are building a house out of matchsticks in a hurricane zone. Does this mean you should never use productive debt? Does it mean an ordinary person should never get a mortgage to buy a modest home? Absolutely not. It means that if you are going to pick up the chainsaw, you must put on the protective gear. You must structure your debt in a way that mathematically guarantees your survival no matter what the economy does. You have to ensure that even if you are wrong, or even if the market crashes tomorrow, you will not be forced to sell in a panic. And the only way to do that, the only way to safely use productive leverage without losing a single night of sleep, is to deeply understand and apply the most important concept in all of investing. You must insist on a wide, unshakable margin of safety. If we recognize that consumer debt destroys wealth, and that excessive leverage can lead to absolute financial ruin, we are left with a very narrow, highly specific path for using borrowed money correctly. This is the path of productive debt. Productive debt is fundamentally different from the consumer trap because of the nature of the underlying asset. You are not borrowing money to fund a fleeting lifestyle, to buy clothes, or to finance a rapidly depreciating luxury car. You are using borrowed capital exclusively to acquire an asset that generates steady cash flow or has a high probability of securely holding and increasing its long-term value. You are buying a machine that is inherently designed to work for you over the decades. For the vast majority of ordinary hardworking people, the most common, most accessible, and most practical form of productive debt is a standard mortgage on a modest home. Real estate purchased sensibly provides shelter, protects you from rising rents, and historically holds its value against the eroding forces of the broader economy. But here is the critical warning that so many people fail to heed. Just because a mortgage is considered good debt does not mean you can use it recklessly. The tool is still a chainsaw. To use it without hurting yourself, you must absolutely insist on a concept that I consider to be the single most important idea in all of investing and personal finance. It is called the margin of safety. To understand the margin of safety, you first have to understand the terrifying way most people approach the home buying process. When an ordinary family decides they want to buy a house, the very first thing they do is go to a bank or a mortgage broker to get pre-approved. The bank looks at their income, their tax returns, and their credit history. The bank runs the math and says, "Congratulations, we have determined that you are approved for a maximum monthly payment of $4,000. This is the exact moment where the financial tragedy begins. The average person hears that number and immediately assumes that $4,000 is their safe budget. They go out and look for the absolute biggest, fanciest house that costs exactly $4,000 a month. But you have to understand what the bank is actually telling you. The bank is not telling you what is safe for your stress levels. They are not calculating a budget that allows you to sleep peacefully at night, save for retirement, or take a family vacation. They are calculating your absolute maximum mathematical breaking point. That $4,000 is the edge of the cliff. If you spend right up to the maximum approval limit, you are standing with your toes hanging off the precipice, hoping the wind never blows. The margin of safety is the conscious, deliberate decision to step far back from the edge of that cliff. Let us borrow a concept from engineering. When engineers build a bridge that needs to carry a steady stream of 10,000-pound trucks, they do not build the bridge to hold exactly 10,000 pounds. If they did, the first time a truck carried a slightly heavier load, or the first time an unexpected windstorm hit, the bridge would collapse into the river. Instead, they build the bridge to easily hold 50,000 pounds. That massive 40,000-pound gap between the expected load and the breaking point is the margin of safety. It is the invisible, built-in shock absorber that guarantees the bridge will survive the unpredictable, unavoidable surprises of the real world. Your personal finances must be built exactly the same way. If the bank says you can borrow enough to have a $4,000 monthly payment, your margin of safety means you intentionally choose to borrow far less. You look for a modest, comfortable house that only requires a $2,000 or $2,500 payment. You create a massive permanent gap between your total monthly income and your fixed debt obligations. Why is this gap so absolutely essential? Because real life is not a clean, predictable spreadsheet. Real life is messy, expensive, and filled with sudden shocks. If you are leveraged right up to the maximum limit of your income, you require the world to be perfect just to survive. But the world is never perfect for very long. The roof of your house will eventually leak. Your car's transmission will inevitably fail. Your child will get sick and need medical care. Your company might downsize, leaving you temporarily out of work for 3 or 4 months. These are not rare, freak occurrences. They are the normal, guaranteed realities of a long adult life. When you have a wide margin of safety, these life events are simply mild inconveniences. Because your mortgage payment is well below your maximum capability, you have breathing room. You have the ability to build and maintain a thick, boring cushion of unspent cash sitting in a secure bank account. If the water heater breaks, you do not panic. You simply write a check from your cash reserves, fix the problem, and go back to sleep. Your emotional baseline remains completely undisturbed. But if you ignore the margin of safety, if you bought the maximum house the bank allowed, and you have 0 cash reserves, that exact same broken water heater is no longer an inconvenience. It is a full-blown financial crisis. Because all of your income is locked up in servicing your massive debt. You do not have the cash to fix the problem. You are forced to put the repair on a high-interest credit card. You have just taken productive debt and allowed it to push you right back into the suffocating trap of destructive consumer debt. You lose your peace of mind, your stress skyrockets, and your financial foundation begins to crack. I cannot emphasize this enough. In the game of wealth building, Survival matters infinitely more than speed. It does not matter how fast you can accumulate assets if a single economic recession or a temporary job loss wipes you out entirely. You must always build your financial life so that you can survive the worst-case scenario without being forced to sell your assets in a panic. The people who truly win over a lifetime are not the ones who take the most leverage risks. They are the ones who build an unshakable margin of safety, ensuring they can stay in the game long enough for compounding to do its heavy lifting. However, maintaining a wide margin of safety is only the first step in mastering productive debt. Even if your monthly payment is perfectly affordable today, you have to ensure that it remains affordable a decade from now. If the structure of your loan allows the bank to suddenly increase your monthly payment, your carefully planned margin of safety can vanish overnight. To truly protect yourself and turn debt into a powerful wealth-building tool, you must understand how to use the invisible forces of the economy to your advantage. And that brings us to the profound mathematical beauty of fixed-rate borrowing in an inflationary world. Once you understand the value of a wide margin of safety, the next question is very practical. How do you make sure that a debt which feels manageable today still feels manageable 10 or 15 years from now? This is where many ordinary people make a serious mistake. They focus only on whether they can handle the payment right now. They do not spend enough time thinking about how the structure of the loan itself can either protect them or slowly trap them. In borrowing, structure matters just as much as price. Over a long enough period of time, there is one economic force that almost everyone underestimates, and that force is inflation. Inflation simply means that the purchasing power of paper money tends to erode over time. A dollar today usually buys more than a dollar will buy 10 or 20 years from now. Most people experience this only as frustration. They notice that groceries cost more, rent costs more, insurance costs more, and they feel as though life keeps getting more expensive. That part is true. But if you understand the mathematics properly, inflation has another side to it when your debt is structured correctly. Let us use a simple example. Imagine that you buy a modest home with a conservative fixed-rate mortgage and a payment that sits comfortably below what your household can truly afford. The critical phrase there is fixed rate, not teaser rate, not adjustable rate, not a payment that can be repriced by the bank in 3 years, a true fixed rate. If your principal and interest payment is locked in, you have created something incredibly valuable. You have locked one of your biggest monthly costs into today's dollars, while the broader economy continues to move. If you hold that debt for a long period, something interesting begins to happen. Your mortgage payment remains largely the same, while wages, rents, and the general price level in the economy tend to drift upward over time. I am not saying your income rises automatically every year, and I am certainly not promising that life becomes easy. Real life does not move in a straight line, but over long stretches of time, a well-structured fixed payment often becomes a smaller burden relative to your earning power than it was on the first day you signed the papers. You borrowed in today's dollars, and you are repaying that obligation over decades with future dollars that are worth a little less. That is the invisible tailwind. It is not flashy. It does not feel exciting. Most people never notice it because it works so gradually. But if you borrow conservatively and lock the rate, time can quietly improve the economics of the debt. Meanwhile, if the underlying asset remains useful and durable, you are not just paying back a loan. You are gradually increasing your ownership in a real asset while the payment becomes easier for your life to carry. This is one of the few situations where time and inflation can work with you instead of against you. But I want to be very careful here because this is exactly where careless people hear only half a lesson and get themselves into trouble. Inflation is not a reason to rush out and borrow money. A fixed rate is not a magic spell. If you overpay for the asset, if you borrow too close to your limit, if you have no emergency cash, or if your income is unstable, then even a fixed rate loan can become a burden. The structure helps, but it cannot save you from bad judgment. Sound borrowing still requires modest assumptions, conservative sizing, and emotional discipline. This is why I have never liked financial arrangements where the lender gets to change the rules on you after the fact. Adjustable rate mortgages, floating rate consumer loans, variable rate debt, and any obligation with a payment that can jump dramatically later on should be approached with extreme caution. When interest rates rise, the bank protects itself first. Your payment can suddenly expand, and the margin of safety you thought you had can disappear almost overnight. A household that felt stable in January can feel cornered by June. That is not a position you want to be in. Think about the difference in plain terms. With a fixed-rate loan, you have clarity. You can plan, you can budget, you can build your emergency reserves around something you understand. With a variable loan, you are effectively inviting uncertainty into the center of your household. You are hoping that future rate movements, central bank decisions, and lender behavior all remain kind to you. Hope is not a financing strategy. If your family depends on everything going right in order to stay above water, then the debt is too fragile. So the principle is very simple. If you ever use debt for a productive purpose, you want the obligation to be as boring, predictable, and one-sided in your favor as possible. Fixed rate, long duration, affordable payment, wide margin of safety, enough cash on hand to survive real life. That is how you give yourself a chance to benefit from the slow, quiet help that time can provide. But even if the math works beautifully on paper, there is still one more test that matters. You have to ask whether the debt leaves you feeling steady or whether it leaves you tense, restless, and trapped. Because borrowing is never just a mathematical issue, it is a psychological one. We have spent a great deal of time talking about the arithmetic of debt. We have discussed interest rates, cash flow, depreciation, leverage, fixed payments, and margins of safety. All of that matters. In fact, if you do not understand the mathematics, you can get hurt very quickly. But there is another side of borrowing that is just as important, and it rarely appears in spreadsheets. Debt has psychological weight. It changes the way a person feels, the way a family behaves, and the kinds of decisions people are willing to make when life becomes uncertain. I have always believed that money is not merely a scoreboard. At its best, money is a tool that gives you options, time, and peace of mind. If your financial life is arranged in a way that removes your freedom, destroys your sleep, and makes you feel permanently cornered, then something has gone wrong, even if an accountant somewhere insists that the numbers still look acceptable. A loan can be mathematically manageable and still be emotionally corrosive. That matters more than many people are willing to admit. Think about what heavy debt does to an ordinary household. It is not just a bill. It sits quietly in the background of every conversation. It affects how you react when your child needs something unexpected. It affects how patient you are with your spouse. It affects whether a small medical bill feels inconvenient or catastrophic. It even affects the tone of a Sunday evening, because part of your mind is already racing ahead to Monday morning and the payments waiting for you there. Excessive debt turns the future into a source of constant low-grade fear. This is why two people with the same income can live completely different emotional lives. One person may have no destructive debt, a modest housing payment, and several months of cash in reserve. The other may earn the exact same salary, but carry credit card balances, an expensive car note, and a mortgage that is right at the edge of what the bank allowed. On paper, they may appear similar. In reality, one person has breathing room, and the other person is living as a hostage to the calendar. Every payday already has too many owners. That psychological pressure influences behavior in ways that are easy to miss. A person under too much financial strain becomes less patient and less rational. They may cling to a job they hate because they cannot tolerate even a short interruption in income. They may stay quiet in a toxic workplace because missing one paycheck would immediately create panic at home. They may avoid learning new skills, changing cities, starting a side business, or making any thoughtful long-term move simply because their monthly obligations have consumed all available courage. Debt does not just take money from you, it can quietly take initiative from you. This is where autonomy becomes such an important idea. When you eliminate destructive debt, and when any productive debt you do carry is small enough and stable enough to remain manageable, you gain one of the most valuable powers an ordinary worker can have. You gain the ability to say no. You can say no to a foolish purchase. You can say no to a lender pushing you toward a larger payment. You can say no to an employer who believes you are too financially trapped to leave. That may not sound dramatic, but over a lifetime, the power to say no is worth a great deal of money. A surprising number of people chase higher income without realizing that what they really want is more control over their life. They think the goal is to earn enough to look successful. Very often, the real goal is simply to remove the financial pressure that keeps them tense all the time. A person with a little less income and a little more margin can be far richer in lived experience than a person earning more but carrying a mountain of obligations. If your lifestyle requires you to remain on the treadmill forever, the income number by itself does not mean very much. That is why I think debt should always be tested two ways. First, tested on paper. Does the math work under conservative assumptions? Can you handle it if life gets unpleasant for a while? Second, test it in your own mind and body. Can you sleep with it? Can you ignore it for an afternoon and still feel calm? If a loan causes you to wake up at 2 a.m. staring at the ceiling, then I do not care how attractive the expected return looks on a spreadsheet. It is too large, too risky, or too close to the edge for your temperament. No amount of projected gain is worth turning your home into a stress chamber. The right kind of financial structure should make you steadier over time, not shakier. It should widen your options, not narrow them. It should help you become more deliberate, not more desperate. When a family gets to the point where high-interest debt is gone, fixed obligations are modest, and a cash buffer sits quietly in the bank, something powerful begins to happen. Decisions improve, arguments decrease, patience increases, the future stops feeling like a hunter and starts feeling like a field you can actually cultivate. And once you understand how much freedom there is in that feeling, you begin to see the final lesson clearly. The goal is not to imitate the rich by borrowing more. The goal is to build a simple protocol that lets an ordinary person use debt rarely, carefully, and on terms that protect their life. If you forget everything else we have discussed, I want you to remember one simple idea. Debt is not something to worship, and it is not something to romanticize. It is a tool. Like every powerful tool, it can be useful in disciplined hands and dangerous in careless ones. The ordinary person does not need a complicated theory of leverage to build a secure life. What they need is a clear protocol. They need a few durable rules that are easy to remember when emotion is high, temptation is close, and financial marketing is doing everything it can to confuse them. The first rule is this: eliminate high-interest destructive debt as aggressively as you can, and once it is gone, make a quiet, lifelong commitment never to carry that kind of balance again. If a credit card balance is charging you 18 or 20%, that is not a small inconvenience. It is a machine working against you every hour of the day. You do not build wealth by trying to outrun that machine. You build wealth by turning it off. For most households, that is the first real financial victory that changes the texture of life. The second rule is equally important. Do not borrow money to buy things that immediately lose value. Do not finance your identity. Do not take on years of payments just to feel successful for a weekend, a season, or a photograph. A vehicle may be necessary. Furniture may be necessary. Certain tools for work may be necessary. But necessity and overfinancing are not the same thing. Keep the purchase modest, keep the debt small, and never confuse convenience with wisdom. The more often you borrow for consumption, the more often your future paycheck arrives already weakened. The third rule is where most of the nuance lives. If you ever do use debt, use it rarely and only for a productive purpose. That means the underlying asset must either produce income, protect a major life cost, or hold durable long-term value. For most ordinary families, that usually means one well-structured home loan, not a collection of clever financial maneuvers. And when you take on that debt, size it so conservatively that real life can hit you without knocking you down. If the bank says you can afford the maximum, ignore the maximum. Build your life around what leaves room, not what flatters your ego. The fourth rule is about structure. Prefer fixed rates, understandable terms, and boring predictability. You are not trying to prove sophistication. You are trying to reduce fragility. A good financial arrangement should not require genius to survive. It should be simple enough that you can explain it clearly, stress test it honestly, and live with it calmly. If a loan only works when rates stay low, your hours stay perfect, the economy stays friendly, and your luck remains intact, then the loan does not work. It is depending on hope, and hope is far too fragile to support a family balance sheet. The fifth rule is one that many people skip because it feels slow and unexciting. Keep cash reserves. Keep more liquidity than your optimistic self thinks you need. A margin of safety is not just about borrowing less. It is also about holding enough cash so that normal life does not force you into panic borrowing later. A job interruption, a medical bill, a broken transmission, a leaking roof, a family emergency, these things are not rare. They are part of being alive for a long time. Cash is what stops an inconvenience from turning into a spiral. And then there is the final rule, which sits above all the others. Protect your peace of mind. If a financial choice makes your life look impressive from the outside but leaves you feeling tense on the inside, the choice is probably too expensive. If a loan removes your ability to think clearly, walk away from bad situations, or sleep deeply, then the hidden cost is too high. True wealth is not measured only by assets on a statement. It is measured by how much of your life still belongs to you. It is measured by how much freedom remains after the bills are paid. That is why I do not think the deepest lesson here is really about debt at all. It is about self-command. It is about refusing to let impatience write checks that your future has to cash. It is about understanding that leverage only helps when it serves an already sound life. Used recklessly, it magnifies chaos. Used sparingly, carefully, and with a wide margin of safety, it can help a steady person buy time, stability, and ownership. But the foundation always comes first. Income that is honest, spending that is restrained, debt that is limited, cash that is real, expectations that are modest. If you can hold to those principles, you do not need to look rich in order to become secure. You do not need to perform well for other people. You do not need to win every financial race. You simply need to avoid the traps that make time your enemy and quietly use the few tools that let time become your ally. That is how an ordinary person builds a life that gets sturdier instead of shakier. That is how debt stops being a master and becomes, on rare occasions, a servant. And that is how wealth is usually built in the real world, not through excitement, but through discipline, patience, and the refusal to make yourself fragile. That's all. Thanks for watching.